It's been called a perfect storm of demand and supply factors that has resulted in a global energy crunch. In China, the demand for coal surged as the economy recovered faster than expected from the COVID pandemic. Supply, however, was hit by supply chain disruptions and recent flooding in the coal-producing Shanxi province. That sent coal prices soaring. Meanwhile, in Europe, an unusually cold and prolonged winter earlier this year left gas supplies depleted. Supply, meanwhile, has been lower than expected due to a series of planned outages and maintenance issues. This has sent natural gas prices surging almost 300% in Europe in recent months.
What has happened is we have now sort of two epicenters of major energy shortages, and both these regions and countries have been pulling in supplies of coal, natural gas, certainly, but even oil to some extent, causing a shortage to ripple out into the global markets.
As a result of the surge in prices of coal and natural gas, many industrials and power generation companies have switched to oil just to keep the lights on. This in turn has put pressure on oil prices, as oil supply has also faced delays and disruptions due to COVID and weather events like Hurricane Ida in the Gulf of Mexico. In the first week of October, the price of Brent crude oil hit its highest mark in 3 years at $83 a barrel. The US benchmark West Texas Intermediate, meanwhile, reached a 7-year high of $79. Some pundits are asking if oil could once again reach $100 per barrel. But not all are convinced.
We have major shale gas supply coming from the US right now, and it's probably not accurate to compare where we are right now versus what we had in the likes of 2006, 2007, when oil was trading above $100. That said, if you put together the demand and supply equations, it does look as though at current stock levels, things do seem a little bit tight. But the point being that demand hasn't fully recovered to COVID levels, and when you take that into account, that amount of supply, although it's tight, has not been as tight as what we had seen before the shale boom. And for that reason, I don't think we would see $100 oil.
Oil cartel OPEC Plus would seem to agree. At their recent meeting earlier this month, they agreed to increase output by 400,000 barrels per day in November, but resisted calls to boost supply beyond that.
They are happy with the market and they continue to be cautious. They don't want to do more. They want to maintain. They believe that the market is balanced right now.
Most of this anticipated extra demand for oil has already been baked into the prices. I do feel there's a bit of a speculative froth in oil, because at the end of the day, if you want to take, as a speculator or an investor, you want to take exposure to coal and natural gas prices, assuming they will continue going up through winter, the derivatives available in the market and the liquidity of those markets is very limited compared to oil. So to some extent, to my mind, oil is being used as a proxy by speculators and investors. And I think some of that speculative froth, I believe, should disappear soon.
However, governments and investors are concerned about the impact higher energy prices will have on inflation when economic recovery is still fragile.
When you have high inflation, that dampens real growth, right? But I think we have seen from the example of China, for example, where a power supply crunch has actually led to them decreasing their industrial output because they are now rationing their power supply for residents' use more than for industrial usage. And with China's industrial output being decreased because of power outages, we expect more bottlenecks in the supply chain, in intermediate good production, and that could impact the rest of the world.
When we talk about inflation, we need to actually distinguish between core inflation and headline inflation. High energy prices will hurt headline inflation and will make the numbers move up increasingly. But where core inflation is concerned, we don't consider energy costs as part of our core inflation. So we do think that where core inflation is concerned, it might be here for a little bit longer, largely because of the supply chain disruptions, but not purely because of the energy crisis that we're seeing at the moment.
So what should investors do to protect their portfolios in this current situation?
You need to consider what are the steps that governments will take to actually counter inflation. And usually you get a higher interest rate environment, right? If you get a higher interest rate environment, then obviously you need to be staying away from the interest rate sensitive sectors, like for example, property or REITs, right? Where, a higher rate of interest will basically be taken not so well by these sectors itself. Then of course, the IT and communication sector will also not fare as well when rates go up. In fact, it's the financials that actually benefit, the cyclicals that actually benefit in that sense.